Hello, welcome back. I'm David with Agricultural Economic Insights, joining you for a chart of the week. And this week, we're highlighting actually a table. We've been thinking a lot about the farm economy, the tough situation crop producers were in heading into 2025. Of course, the trade disputes with China, where the tariffs back and forth are extremely high. It's very likely we'll export any ag goods. We might actually get zeros in some of the trade data. But one thing about sort of some of the offsets, some of the good news that producers might be able to anticipate is maybe some ad hoc spending. There's the precedent set from 2018 and 2019 of the CCC funds being used out of the USDA to for the executive branch to authorize some payments to producers. So we want to recap. It seems like it happened just a few years ago. We want to recap some of the mechanics of those programs and think about maybe the chances of that happening or another program being authorized here in 2025. So what we did is we stepped back and we reviewed the programs. A couple highlights I want to mention is it wasn't until late in the summer that the 18 and 19 programs had enough of an announcement that producers could start to put pencil to paper, so to speak. Uh, in 2019, there was an announcement in May that there would be another round of funding, but it wasn't until July until the math came together. And of course, it wasn't until August till those payments were going to be made. That's the second piece here is those payments really didn't get authorized until late in in the summer. So the 2018, 50% was allocated and available starting in August, and the second 50% was announced it would be paid out in December. The USDA always had some optimism that there'd be a trade resolution that wouldn't make the next round of payments necessary. In 2019, 50% was available in August, 25% came later in the fall, and then the last 25% came early in the 2022. Now, another key feature of these programs is 2018 was based on actual bushels produced, actual production, and then 2019 was based on a county payment rate. So what they did is they said, this county has this historic composition of eligible crops, and this is the production for those crops, and these are the trade losses that we anticipate. So they multiplied all that together. So Crawford County, Kansas, Tippecanoe County, Indiana, they all had their unique payments. So producers in that area would take their actual planted acres, multiply by that county rate, and then that would give them a starting point for those different payments. So here is the table that we want to focus on and help you to think about is what those actual rates were. So in 2018, corn had an estimated USDA loss of a penny. That increased to 14 cents. Now, look down a couple rungs. The soybeans, there's $1.65 in 2018. That jumped up to 205. Now, if you're thinking about this, corn has a lot more bushels per acre than soybeans. But again, soybeans had a really big footprint. A lot of soybeans are exported, almost 50% are exported. And a lot of those exports are bound for China. So when you think about soybeans, also is a 80 to 90 million acre crop in the United States, and so it has a really big footprint. It's going to get a lot of those potential payments, and those potential payments are going to be pretty large on a share per on a dollar per acre or even a dollar per bushel measure. You can also see the 2019 program was expanded quite a bit. A lot more crops were included. I want to note here the USDA's methodology. You could read more about this on your own, but one of the key features here is they were looking at sort of a expectation of trade loss, loss of markets, and then they were converting that into a bushel payment. So I think one of the biggest challenges with a trade war, especially if it's prolonged, is that the ending stocks start to pile up. And so if we were to keep making these payments on a loss of exports, the ending stocks would have piled up eventually, and that would have put producers in a really tough situation because the commodity prices would have kept going lower. So there's this sort of initial shock of loss of markets, and then the long-term shock is what happens to the commodities as prices start to deal with uh, burdensome ending stocks, but also soybean acres and that excess production finding its way into other crops. There aren't a lot of great tools for risk management. We open a new Ag Forecast Network question for those that are really curious about the probability of a $10 billion program, at least $10 billion worth of direct payments being announced for trade mitigation here in 2025. But we'll wrap it up here for this week. Encourage you to follow the article link down below. And if you're not already a subscriber to AEI Premium, encourage you to take advantage of that now. Until next time, stay curious.